The market hates Uber stock right now. It's down almost 20% from its all-time high. Investors are concerned that autonomous vehicle providers like Tesla and Waymo are disrupting Uber's business model. Add to that the recent earnings miss, and you can see why the stock is trading down. But do these investor fears create a massive opportunity to buy a compounding machine like Uber at a discounted price? That's the question we'll be answering in this video. We'll look at Uber's business model, moat, and fundamentals. I'll also reveal my Uber stock valuation towards the end. Uber stock's trading down alongside the market as investors are currently panicking about AI. More specifically, investors are worried about how software companies will be impacted. It seems the market has already decided that AI will inevitably kill all software stocks. Even those that are currently highly profitable with strong moats like Microsoft are struggling. But at the same time, the company's also punishing those companies that invest heavily in AI. For example, Amazon just reported earnings and guided for $200 billion in capex spending for 2026. The stock subsequently dropped over 10% in a single day, despite management's emphasis on the long-term return on investment that this capex spending will produce. But what about Uber stock? Is this drawdown something we should be worried about? To answer that question, we have to understand Uber's business model. As investors, this is the first thing we should be focusing on when buying a stock. If we don't understand Uber's business model, how will we know what to do when a stock goes down? Uber offers rides and food delivery services via the Uber app. We can see by looking at their gross bookings, roughly half of the business is in mobility, meaning rides, and the other half is in delivery, meaning food delivery. A negligible portion of bookings come from freight. The key insight from Uber's booking numbers is that despite being equal in bookings, mobility and delivery are not equal in profit. Mobility has much higher margins than delivery. That's why disruption to Uber's rides business by autonomous vehicles is a big concern. Despite these concerns, Uber's trips continue to rise at an impressive rate. The 5-year average growth rate in trips is over 22%. This suggests that even though AVs may pose a risk to the business long term, the current reality is that demand for Uber services is only rising. If we then look at monthly active platform users, we can see consistent growth, with a 5-year average growth rate of nearly 17%. And that growth rate has actually accelerated recently to over 18%. So the idea of Uber's business model being under imminent threat from AVs is certainly misguided based on these numbers. The most important yet undervalued part of Uber's business model is their Uber One subscription. The Uber One membership provides certain benefits to subscribers. The important thing to know about Uber One is that the benefits are in both rides and delivery. As far as I'm aware, no other company at Uber's scale has this kind of overlap between rides and delivery, making Uber One a unique proposition to the customer. As we can see from the chart, this unique value proposition is appealing to Uber's user base. Uber One's membership has grown over 50% in the past year, from 30 million subscribers to over 46 million. Uber One is crucial because it helps to lock customers into the Uber ecosystem. And then there's the potential for huge advertising revenue. Uber can use the huge amount of unique user data collected on a daily basis to show targeted ads on its platform. The company is already making over $2 billion in advertising revenue. The important thing about advertising revenue is that it's highly profitable. Whilst margins on mobility are around 30%, margins from advertising are likely to be above 70%. Advertising is already a significant contributor to Uber's bottom line. So now we understand what Uber actually does. But does the business have a moat? Like most platform businesses at scale, Uber benefits from a specific competitive advantage that protects the business from competition: the network effect. Uber's network effect starts with what we mentioned earlier: monthly active platform users. With 202 million of these monthly active users, the demand is certainly there. To meet this demand, Uber has developed a gigantic network of drivers. Over 9 million monthly active drivers and couriers to be exact. So how does this high supply of drivers actually help the business? More drivers on the network means shorter waiting times for rides and delivery. Over time, consumers notice these shorter waits and switch over to Uber from their competition. I know this because I did it myself. I used to use other delivery platforms and they would take so long to deliver my food order. When I switched to Uber, which I already used for rides, I was shocked by the speed of delivery. But how will Uber's network effect hold up in the age of AVs? Uber's aim is to become the demand aggregator. This means they open their platform up to any AV company, of which there are dozens, to operate on their network. This is a win-win situation because Uber's network gets stronger by providing more supply to serve the demand of users. Drivers are Uber's largest expense. So if they can meet demand using AVs instead of deploying more human drivers, it may actually bring down costs and improve margins. This narrative isn't covered very much by the mainstream news. However, I see it as the more likely outcome than Tesla and Waymo disrupting Uber's network. That narrative seems to get way more coverage than it deserves because negativity gets clicks. I think it's more likely long term that companies like Tesla and Waymo work with Uber to meet demand where it's at. We're already seeing this with Uber's various partnerships with Waymo in Austin, Texas and Phoenix, Arizona. Uber's actually partnering with Wave, another AV provider, to bring AVs to London. This shows Uber's willingness to work with smaller players and diversify away from Waymo. When looking at Uber's fundamentals, we see evidence that the company is only getting stronger over time, contrary to the bearish narrative around the stock. If we look at Uber's operating margins, we can see that the company went from negative margins only 3 years ago to margins over 12% today. It's almost as if the company is being punished for actually making money. This trend is also seen in Uber's profit margin. However, it's a lot more volatile due to certain accounting discrepancies. Uber has a large portfolio of investments, which muddies the water in terms of net income. That's why when analyzing Uber stock, it's important to focus on the free cash flow because this is the true underlying profit that is left over after accounting for all expenses. Speaking of free cash flow, this is what we'll be using to come up with a valuation for Uber stock. Uber's current free cash flow yield is over 6%. On the surface, this seems quite cheap because most mature companies trade at around a 4 to 6% free cash flow yield. But Uber isn't a mature company. As we discussed, most of Uber's metrics are growing at anywhere from 15 to 50%. So there's clearly a discrepancy between the market's opinion of Uber stock and its true underlying value. This discrepancy is most likely due to the AV disruption narrative. But as we discussed, this isn't as disruptive to Uber as the media would like you to believe. Let's switch over to the Qualtrim DCF calculator to find the expected return for Uber stock from today's price. We have to come up with some assumptions for Uber's free cash flow per share growth over the next 5 years and the appropriate free cash flow yield that the stock should trade at. As we can see here, Uber's free cash flow per share has exploded recently. However, I don't expect such explosive growth moving forward, although I'm confident they'll compound free cash flow per share at a rate of 20% over the next 5 years. And then in terms of free cash flow yield, I think it's reasonable for Uber stock to trade at roughly 4%. With these assumptions, Uber stock should return over 30% annualized gains from today's price of around $75 per share. These are market-beating returns. If this scenario were to play out, Uber stock could trade at $292 per share by 2031. That's why I've invested $500 of my own money into Uber stock. Unfortunately, I'm currently down over 13% on the position, but volatility is the price you pay for those extraordinary returns. We have to be able to stomach the ups and downs of the market like we've seen in the past couple of weeks. We had a huge drawdown back in April 2025 due to President Trump's tariff policy, but despite that, the portfolio still ended up with a positive gain of over 15%. That's why I'm remaining patient and holding through this software sell-off. The market should reward us for that patience over the long term. If you enjoyed this video, click the next one for more.